CPA firms don't come in, they're not all the same size. And generally, generally the CPA firms, they're the size of their client. And what I mean by that is small CPA firms usually work with smaller clients. Larger ones work with larger clients. If you have a CPA firm that you could have a CPA firm, just one person. You know, if when you get your CPA license, if you want to be a CPA by yourself, and a lot of people do, you know, you can do it. So, but they generally usually get smaller clients. If you have an office of say 10 people, you can't audit Ford. You know, Ford has places all over the world. You have to have offices all over the world to audit Ford. So generally, the size of the CPA firm matches their clients usually. All right. So they go in different sizes. So local firms, these are usually in one city or one local area. Oops. Let me do something here. So one location or one area. Usually, say 1 to 10 partners. And also usually that they have a smaller portion of their practice is for auditing. How better off this? Well, I'll say less auditing. How about that? We know what that means. So usually, yeah, they have less auditing. They do more things like, you know, what do they make their money doing? They make their money doing, you know, taxes, financial statements. These are called compilations in our audit terminology. Consulting, that sort of thing. So these are kind of what they make their money doing. They'll make their money taxes, financial statements. So you have somebody that runs a photography studio and they want to know how well they're doing. You make their financial statements for them. Those are called compilations. Consulting, people want to know how to do something, how can they make something better, those sort of things. They don't do much auditing. And the reason they don't do much auditing is that a lot of times their clients don't require it. If you're a small, let's say there's a photography studio, they probably aren't going to get an audit. The only time that they would get is if they're big enough to say they get a bank loan, then maybe the bank requires an audit. But even the banks a lot of times don't require audits. There's a few different choices that we have. There are things that, you know, something called a review, which is a much reduced audit. But audits are just too expensive. And a lot of times you have you know, let's say that you have a successful photography studio and maybe they're making $200,000 a year. Okay, you know, making some good money. Okay, but you say, okay, we want to do an audit. How much does the audit cost? $80,000. Now, does it make sense to out of 200,000 of income to spend 80,000 just to get the audit? So a lot of times, you know, even successful clients, they don't get audits unless there's a bank that really wants it. But usually, it's much less of their work, let's say, than as you move up. Okay, regional firms. Usually in, well, let's say 3 to 4 states. Maybe more, I don't know, 3 to 10 states, maybe, I don't know, it really depends. But they're usually in a specific region. For instance, the one region we're in is often people talk about is Wisconsin, Illinois, and Indiana region. That's a region that is commonly referred to as far as, I mean, that's just county with other things. And these usually have more people. Usually say 10 to maybe 25 partners, depending. And they will do some auditing because they have clients that will be required by usually things like lenders, banks, investors, things like that, to have audits. When you reach a certain size of a client, when you're talking about not tens of thousands or hundreds of thousands, but you start talking about millions of dollars, and it's not unusual to have places that are like that. Sometimes you'll have investors that want audits, and sometimes you'll have banks that demand audits. So they'll do some auditing. They'll still do these other things too, but less of it. Yeah. Okay, national firms. These are usually in say 40 plus states. It's a lot more in all 50 states. It depends. And they usually have, say, probably 40 to even up to a couple hundred partners. And they will definitely do auditing. They may have clients that are publicly traded, which require a audits. They'll still do some of this other stuff. As they move up, you'll see the compilations kind of drop out, though. They can do compilations, but a lot of times these will be the ones that kind of drop out a little bit. They'll do auditing, taxes, consulting. You won't see them comparing the financial statements very often because a lot of times large clients will have their own accounting departments. They don't need someone to come in and do their financial statements. They already have people who will do that. So as you move up, things like some of the taxes and things like that will kind of go away from the CPA firm. Small businesses, they don't do that kind of stuff. So you'll do all their taxes, you'll do all their compilations. As you move up, they have their tax department. They have a the accounting department, certainly. And so you generally do less and less of that kind of stuff. You do more of the auditing, you do more of the consulting and taxes too. And a lot of times the taxes are because they become more complex. Okay, international firms. In the US, these are the big four. Deloitte, Pricewaterhouse, KPMG, and Ernst & Young. Okay, and these can have 1,000 plus partners. They're all over the world. And these are truly international. And they may have hundreds of overseas offices. Oops, that's not about hundreds. That's not it either. I should say overseas. Well, that doesn't matter. Let's say foreign. And they will definitely do auditing. They'll do auditing, taxes, consulting, and they have the biggest clients in the world. And the reason is they're the only ones that can do those. So you have Microsoft, Walmart, Google, all these, they're going to have places, Apple, they're going to have places all over the world. And it takes an international accounting firm to do the audits for those people. If they have they have places set up in 32 countries, you got to have people that can go to those 32 countries, or people that you can rely on in those 32 countries to help you do the audit in those 32 countries. Sometimes they'll have business arrangements with other CPA firms and stuff. But anyway, obviously, you got to have people all over the world to audit those kind of companies. Just the nature of the business. So, the idea of like a small CPA firm getting a large client generally doesn't happen. And two, if you are a small client and you have a client or a small CPA firm and you have a client that's really moving up, at some point, they're probably going to go to somebody else, because at some point the audit's going to get big and complex and you're probably not going to be able to handle it. Okay, so these are the kind of the 4 different levels. As far as the prestige goes, the big 4 are the firms you want to try to get into. All of these, I will say that all of these will give you a good experience, and they'll all give you a leg up. National firms too. There's actually some very large national firms that you can get into, but the international firms and the national firms, I think those are the 2 that really give you quite a leg up in accounting in general. And a lot of times they kind of leapfrog you ahead of other people. So if you have experience, go look at the ads that what they're looking for some of the jobs in accounting, certainly in auditing, but especially in accounting, they'll say 2 years of CPA firm experience or something like that. Those are companies that usually are issuers. They have to issue financial statements, and they want people that kind of know the process, know how this all fits together and all that. And they like getting people from CPA firms. Working in CPA firms is, you're kind of looked at as a little bit of the hot shots, of the accounting world. And so, if you can get into them, I strongly advise you to get into them. And we'll talk about that in a second here. Okay. Oh, question. Spacing looked funny. Okay, which of the following types of CPA firms would appropriate to perform an audit of a bakery that has operations in Illinois and Indiana?
Local firms?
Regional?
Yeah, probably one of these 2. I would say I lean more towards probably the regional firms, because they're in more than one state. You might have, for instance, if you're local, you may know Illinois laws for sales tax and all that kind of stuff. It could be a local firm, but I would say probably more likely the regional firm. And yeah, and they kind of match, kind of matching what they go with, what the size of them is compared to the size of the client. Okay, now CPA firm positions. There are 4 of them, and you may be wondering, well, wait a minute, CPA firms are private businesses. Why are there 4 categories? This firm might have no categories. This firm might have dozens of categories. Why are we showing 4 of them? There's actually a good reason why we're showing 4 of them. The AICPA has rules based on your level in the organization. People higher up in the organization are held to a higher standard. Partners and managers and things like that. All right, so they have to identify it, and the AICPA will say, look, okay, there's these 4 categories. There's partners, managers, senior auditors, and associates. You may have 7 layers in your CPA firm. You have to fit them into those 4 categories. So everybody has to fit into one of those 4 categories. Whatever category you come up with, that's what they have to fit into. So even though you can have your own firm, you can have as many layers or less layers or as you want. The AICPA says for our rules, you have to fit them into these 4 categories. Knocking things over. I'm being so impassioned by my own speech that I knock things over. Okay, staff assistants. Sometimes called associates. And these are first jobs right out of school. They almost all come out of internships. They do not need a CPA license. Okay, so let's talk about this. So these are usually the first jobs that you have in a CPA firm. They usually pay pretty well. They'll work you a lot. It's good to stay, hang in there for a good, 1 or 2 years. Try more for the 2 years here, even though they're working you to death. But this is where most people get their experience from, 1 to 2 years. They mostly come from internships. And so this is another kind of quirk of CPA firms and getting into them. The internship is more like the job interview. In most ways, when you are going through school, you have internships, and you might get jobs out of those internships. With CPA firms, it's almost exclusive, and landing the internship is the hard part. Once you get the internship, they'll work you 40 hours a week. They'll pay you pretty well. They pay, I think, $25 an hour or something like that. I mean, you're not going to get rich doing it, but it's not bad. And a lot of people have unpaid internships, so $25 is way better than zero. But anyway, that period of time that that's almost like your test. Your test where they're going to see if they're going to take you or not. And probably 90+% of people who go through internships get job offers. It's very common to it, and that's one of the things that's quirky about them is if you didn't do an internship with them, you're not likely to get in with them. Also, if you do an internship with one CPA firm, you can't go to a different one. If you did it with whoever, KPMG, and you say, okay, well, I want to work for Deloitte, Deloitte's not going to take you because Deloitte has their own way of doing things, and every one of them is as arrogant as you can be. They don't think that there's any other way to do auditing except for their way, and so if you aren't indoctrinated in their way, they really aren't going to be looking for it. So unlike other jobs where you say, okay, the more experience you have, the more likely you are to get in, right? If you're, I worked at a bank, blah blah blah. It's not that way with CPA firms. It's the internship. They'll come in, they'll teach you their way of doing it. Every CPA firm has a different way of doing stuff. They have different ways of gathering data. They have different ways of recording it and putting it in their work papers. They have different ways of moving people up and promoting people and all that kind of stuff. They're all different. And they all expect you to do it their way. If you say, well, I worked over here and this way was better, that's like the worst thing you can say in one of those CPA firms because they have their way of doing it and that's the way it is. So landing the internship, and usually the internship comes in your junior year. It could be your senior year, especially if you're going to add on a year for college for the if you're going to get a master's or something like that. But anyway, that's what you need to get to the CPA. So you get your internship. After you graduate, they usually give you a job offer. You come in and start out as I forgot my own staff assistant or associate, and That's your starting point. Now, during that time, if you plan on moving up, you do have to take the CPA exam, because to move up to the senior, you will have to. Any questions on that, by the way? So getting that internship is your foot in the door, and it's very difficult to get in otherwise, to not do it through an internship. And again, once you do the internship is basically the CPA firm that you want to work for. So kind of do your background, and now it's a lot easier with internet and all that. But do your background and figure out which one maybe you want to go to if you're planning on going that path. It's a lot of work, especially during their busy season. Their busy season is usually late October, and then it goes all the way through maybe to like April. And if you're in the tax department, that's usually at the end of the year is kind of the same thing. And then they kind of have the dead months that are June through whatever, October. Those are very slow, but during those busy months, they'll work you to death. I mean, 70-hour weeks are not unusual. And even when it slows up a little bit, they'll say, well, on Sunday you can come in at 9, sleep in, but it's very good. It's a very good experience, and it really moves you up. A lot of times you'll be able to get jobs, say after a couple years in a CPA firm that maybe would take you 5+ years if you went a different route. So it definitely is a jump start. Any questions on that? No? Okay. Well, anyway, if you are thinking about going that route, and it's generally the more, probably the more lucrative way to do it. A lot of work, but more lucrative. Again, the internship is really the kind of way to go there. Okay, senior auditors. Senior auditors will run an audit. Run an audit. The CPA exam is directed at seniors. Two S's or one? I don't know. So the CPA exam, these are people that actually run the audit. And when I mean they run the audit, they run the audit. And you think about it, they may be 2 years out of school, and you may be running the audit for, I don't know, a very large company. So it is quite a bit of responsibility. They move you up pretty quickly. As a staff assistant or associate, you are going to be moved around to different areas, and they'll see, okay, well, we'll have you audit cash. See how they do auditing cash. We'll have you audit accounts receivable. See how they do with accounts receivable. We'll have you audit inventory. See how they do inventory. And the reason for them doing it is, you'll think it's probably because of torture. They want to torture you, but actually what they're doing is moving you around so you get a big picture, so that when you become a senior, you can run the audit. And so it's intensive, it's very intensive. And again, after a couple of years, if you pass CPA exam, they'll move you up into the senior position. If you don't pass the CPA exam, you're not going to go into the senior position. You have to have a CPA license to be a senior, and that's state licensing. You can't run an audit unless you have a CPA license. So seniors are kind of important. And again, this is what the CPA exam is on. By the way, sometimes the senior will be called an in-charge auditor, or just an in-charge. And they'll be running the entire audit. And this is when you're a where am I at? when you're a staff assistant or associate, you basically do whatever the in charge tells you to do, and you do it to their however they want it done. You do it to their. They'll say, well, why don't they focus the CPA exam on the new people, the assistant, the associates? Well, that would be really easy. It's like, anytime you get a situation, you say, what do you do? Well, whatever the senior auditor tells me to do, that's what I do. So, it's focused on the senior. And again, this is one of those things that auditing is all judgment, and the senior will have the judgment. By that time, they'll kind of know what to do. I think maybe I didn't tell you this, but I'll bore you if I did. But I remember working with the external auditors. I was an internal auditor at, it was at Navistar. We sell trucks, and we also have an insurance company. And I think I told you I found like $100,000 misstatement, and I was all excited about it. I go to the external auditors, and they just looked at it with a blank look because they're like, "Why are you showing me this?" To them it wasn't material, and you don't do anything with it. But you learn that judgment, and everyone goes through this. Every time you talk to someone who started out auditing, they'll talk about how they found this, the $7,000 error, and they took it to their senior, and like, don't bother with that, get back to work. So anyway, this is where you kind of learn your judgment. Okay, managers. Managers will usually run usually a few, maybe like 3 to 10 audits. They will work with the seniors. And these are people that the senior will be most talking with the manager. So they'll usually have a close relationship with the manager, and the manager will be the one that they are going to talk to about moving up, possibly going from a senior to a manager. Is what do these managers think of this person, and can they move up into the manager position? So, So you have the interaction with the senior auditor. So you might be running audits for, I don't know, Ford and Granger and whoever else, and you'll have different seniors doing these audits, and you'll keep tabs on all of them, make sure they get done on time, make sure that the clients are happy with the time that you're going to. Any problems that come up, the manager is probably going to be the one that troubleshoots it. If it goes to the partner, it's a little bit extreme, but usually the managers are going to be 90% of any problems that arise, and any real deep judgments that are going to need to be made are going to be made by the managers. Yeah, so as you move up, this is kind of where you run to, the managers. Partners. Partners have a job of to obtain clients. And that's any partnership is going to be run like that. That partners are required to obtain clients. And how do you make partner? By getting clients. As you're a manager, you start pulling a client or two. That's how you become partner, bringing in business. So partners are there to get clients. They generally don't run the audits. They'll look over the audits. Obviously, they'll approve them and see what you did and all that. But they won't. They don't interfere too much. There is an oversight of all of this, in that the senior will look at what the associate's doing, and everything that you do as an associate, you document, so that someone else can come in and take a look at it and see exactly what you did, how you got your numbers, where they came from, all that. It's all documented. And the same thing is for the senior. The senior, all this stuff has to be documented. It all has to be in there. It must be, and everything must be repeatable with the same result. So if I look at a sample of items and I come out that there's 300 in the sample and that 3 of them are wrong, someone else should be able to come up, pick that same sample, find the 3 that were wrong, and come up with the same result. The judgment might be different. Someone might say, well, having 3 errors is bad. Someone else might say, 3 errors isn't that big a deal. But the result will be the same. And so that's one thing you got to think about auditing. You keep everything you do goes into the work papers. Those work papers are checked. And the work papers are there so that if you get hauled into court, that you can say, well, wait, we did what we were supposed to do. Look, here's what we did. Here, this is all the data. This is the conclusion we came up with because of this data. Here's our, facts backing up our judgment and all this kind of stuff. You prepare it like you're going into court. That's what the work papers are there for. It's a very serious thing. If there's a fraud or a serious error in financial statements, the auditors catch it. Another thing about auditing that is similar to, let me go back to the screen. Another thing is that they're considered professionals. For legal purposes. These are generally given to people who have a monopoly on a type of activity. They're given a monopoly on a type of activity. And let me give you some examples. For instance, practicing medicine. You have to have a doctor's license. That's nice for a doctor. Practicing law. You must have you must pass a bar exam. You must have a legal license. Practicing auditing. Oops. Must have a CPA license. Okay, so these are monopolies that are given to different groups of people. They have exams usually that they are given these licenses for, and they are given the exclusive right to do something. So for instance, I can't practice medicine. I don't have a law degree. Or I don't have a law degree. That's true, but this time I can't practice. I don't have a medical license. So I can't practice medicine. Only doctors can do that. So they're given this exclusive right. You go, well, gee, man, that's like printing money, right? I mean, you get the exclusive right to do it. No one else can do it. There is a catch to it. And the catch is you cannot have a corporation, a standard corporation that we think about for businesses. If you have a business and you're worried about getting sued, you set up a corporation. The corporation is a legal entity separate from you. And if something really bad happens and they sue, okay, this corporation can go bankrupt, but it won't affect me because it's separate from me. You cannot do that as a professional. You cannot avoid the liability. It's unlimited. So they can, if you get sued, they can take everything you own, personal stuff, houses, cars, boats, or whatever you have. They can come and get them, and that's why they have malpractice insurance. If you're wondering what malpractice insurance is insurance for people that can't form corporations. If they can form corporations, they could avoid the liability. They can't. They're prohibited from anything that limits their liability. So they generally have malpractice insurance, and as a CPA, you'll have malpractice insurance too. Now they do have. It is possible. Hold on. Yeah, actually, I'm going to do something that I'll probably regret. I'm going to try switching videos. My document cam. Okay. I lost my pen. All right. So here's the problem with partnerships, and this is generally what So if you start out in a profession, you usually partnerships. That should be one word. Partnerships. Okay, partnerships. So you have more than one person. So here's two people. This is person A and this is person B, and they have a partnership. Now, suppose they add someone to the group. So let's say they want to add partner C to the group. Here's what happens. This partnership is dissolved, and a new partnership with A, B, and the new partner C is formed. A retires. Another new partnership. The people that are left, B and C, have a new partnership. So this is a new partnership once A retires. So every time a new partner comes in or a new partner leaves, the partnership is dissolved. Weird. Well, look, it's like a boat. Okay. I'm gonna move it. So that's a problem with partnerships. So the problem with partnerships is that when someone comes into it, it gets dissolved. Someone leaves it, it gets dissolved. There is such a thing as a professional corporation, and so a lot of times you will have what they call a professional corporation. And a professional corporation, so they can be partnerships. Professional corporations. Professional corporations are entities that they say, okay, look, we can't keep, if you have a small firm, one or two partners, a new partner coming in probably doesn't happen all that often. Okay, it's not that big a deal. If you have a large, a national or big four, partners coming in and leaving every week. So you cannot have a new partnership form 3 times a week. Okay, so what they do is they have what they call a professional corporation. A professional corporation is when you come in, they give you a share of stock. It's only given to people who are in this professional corporation. You still have all the same liability as before. Professional corporation can get sued just like partnerships. There's no corporate, immunity, but they give you a share of stock. If you leave, you give the share of stock back. So they do it by shares of stock rather than, eliminating the corporation and starting a new one. It's an easier way to keep continuity with the business and that sort of thing. So you will find professional corporations, and professional corporations, again, are just there to make it easier than dissolving and creating new partnerships. So while you can't have a corporation that limits your liability, there are these things called professional corporations. Okay. There's one more thing I have to talk about. And that is, let me go back. You'll notice something that I have here. You'll notice that this says 1 to 2 years. This says 2 to 5 years. What this means is, if you're a staff assistant or associate and you don't move up to be a senior auditor, maybe they think they can't, maybe they don't have a spot for you, it's up or out in CPA firms. You don't have someone as a staff assistant for 5 years, 10 years, anything like that. So CPA firms, it's up or out. And this is for all partnerships. So if you're thinking about looking at this and saying, wait a minute, why? Well, can I do this for 3 years or 4 years? No, not usually. It's either up or out, and you might say, well, why is that? Well, if suppose I'm a great, associate, and I don't need the extra money or anything to move me up for in charge. Why don't I just, wouldn't you have an associate that has 5 years of experience rather than one that has 0 or 2 or whatever, whatever. They're actually, this has to do with partnerships. Nope, not that. This has to do with me figuring out. Here we go. All right. I gotta figure out why is this looking like that? It looks like it's level, but it doesn't. All right, well, there we go. Okay, so here's kind of how it looks. Here's your CPA firm, and you'll have a partner, and they'll have managers. And underneath there, they'll have, I'm not going to do all of them. We'll just, they're going to have seniors. And underneath them, we're going to have associates. Okay. A partnership to live needs partners. Partners bring in business. And this is all partnerships. How do you make partner? You bring in business. Okay, so we have these associates down here. Now, notice what would happen if we let these associates just stick around forever. Eventually they know, okay, this person stays around, okay, they're going to stay around for 5 years. Eventually, if you let people stay around here, these will all be taken up by people who are not going to move up into the senior position. Same thing with the senior, if you can't make them into managers, you're going to move them out. So if they're a senior, you don't have the seniors come moving up. They're going to block up that spot. Let's say the senior here for 10 years. That's 10 years of a senior in that spot that can't move up to manager. And eventually, the partnership would die. So in any partnership, any partnership, it's up or out. So, and that's whether you're in law or anything else, if they can't move you up, it's out. Now, they usually, when they move you out, They try to get you a job with a client. Okay, so if I'm auditing IBM and I have um let's I have a associate that I can't move up to senior. Maybe they didn't pass the CPA exam. Maybe I just don't think they can do it. Um, what I try to do is get them jobs with the clients. And why would a CPA firm do that? Why don't they just show you the door?
Uh, because the associate already knows how to prepare not financial statements, how everything works at the partnership, so they would be able to like marry those procedures and processes with the firm that they're going to. So it's gonna be easier to manage.
It'll be easier for the man.
And you represent them, yeah.
And exactly, perfect and perfect. Yes, it's going to be easy for that. They want you there because when they come in and start working on stuff, they know that you're going to know exactly what they're asking for when they come up and ask for information and all that. And also, they want you to represent them. If you can get a number of and a lot of these clients will have, well over half their staff will be from the CPA firms. You have some big, let's say IBM or something like that. Well, why do they want to have their people in there? Let's say I don't know who does the audit for IBM, but let's say it's Deloitte. So if Deloitte is doing the audit, when it comes around to who's going to do our audit, Deloitte. Everyone there, it came from Deloitte. They want Deloitte. It represents Deloitte in the firm itself, in the client itself, in IBM itself. So IBM is getting the audit, but a lot of their people come from Deloitte. They're a CPA firm, and that CPA firm will have that connection. And the people working for IBM, the audits will go a lot smoother. All the people came from Deloitte, or a lot of them did. They'll know exactly what to do for the audit. So it makes sense for them to try to get people jobs in with their clients. And they'll do this, and a lot of times the clients will pick them up because these are considered, kind of the hot shots coming out of the CPA firms. Yep. So even though you might say, well, gee, it's pretty cold, either you move up or you get kicked out. And quite honestly, a lot of times people get kicked out, they're really happy because a lot of times they move into a job that, they're not going to be working 70 hours a week. They're going to be working, kind of like human hours, like 50 hours a week or something. That it's going to be, it's usually a lot less work. And they usually get bump ups, in pay. You get more money and less work. And, that's, who wouldn't want that? Okay. Where am I? Is this the last part? All right. Okay. Going to chapter 2. This shouldn't take very long. I think we talked about this last time. The American Institute of Certified Public Accountants, the ICPA, they make rules for who? I'll give you a hint. You almost can't go wrong with this one.
B.
They do. They make for B, and they also make them for A. Usually, the states will adopt rules that say from the ICPA's rules, and so those will be and issuers. Even though they have their own government agency, we'll talk about down here. Even though the issuers are regulated by the federal government will tell them, look, you got to follow the AICPA's rules. If there's a conflict, you go with the government rules. But if there's not a conflict, you still have to follow their rules. So even though you might say, well, it's, we're regulated by the PCAOB, that's true. However, you don't have to. You generally are required to follow the rules of the AICPA. Okay, is it a government agency?
No, it's not.
Nope, it's club.
It's a club. Yeah, I remember that from last time.
Uh, can they issue or revoke CPA licenses?
No, only the states can do that.
Yep, very good. They register CPA firms for issuers. They actually don't. The PCAOB is doing that. I don't think I talked about that. They create the CPA exam.
Yes.
Yes. So they actually make the CPA exam, and again, every state uses it. They don't have to, but every state does, and there's not going to be any change in that, I don't think. Okay, so not publicly, not a public, not a government agency. They don't have any direct power over anything, but they get their power from states and federal governments saying you have to follow the rules of this group. Okay, state laws. Can't go wrong with this one either. Both. They make rules for privately held and publicly held. Just because you're a public corporation and you're, underneath the SEC does not mean you don't have to follow state rules. Okay, state laws, are they, is it a government agency?
Yes.
Yep. Issue and revoke CPA licenses.
Yes.
Yep. Register CPA firms for issuers. This is going to be a no.
No.
The federal government does that. They create the CPA exam.
No.
Okay. The PCAOB, and this is kind of the new, I shouldn't say new, it's like 20 years old now, but PCAOB is the Public Company Accounting Oversight Board. This is the federal government. Who do they make laws for?
Is it for both also?
Actually, it's not. It's only for,
It's not
it's going to be only for the issuers.
public. Okay.
And here's why. The only reason why the federal government can regulate anything is if it's between states. And if they are not an issuer, you can't buy their stock. There's no transaction that can happen between the states on that. They have no power. So again, if you're IBM and the PCAOB says something, you have to follow it. If you're Joe's hot dog stand and the PCAOB says something, you just ignore them. They have no power over you. Okay, is it a government agency?
Yes.
Yep.
Yes, it is.
Can they issue or revoke CPA licenses?
No.
Only states can. Register CPA firms for issuers.
No.
Actually, it's yes. This is
It is. Yes. Okay.
well because it's
Yeah. I was
yeah, these are all no, yeah. That's the only thing.
referring to
That's the only thing they can do. Now they can't take the CPA licenses, okay, but they can this registration for CPA issues. They do control that. And while so they can't take your license. So let's say that you make them mad somehow. The PCAOB cannot take your license. They can revoke your registration. Now, if you are a large firm and you make your bread and butter auditing publicly traded companies, that's a death knell. I mean, so while it might seem, somewhat trivial, it actually isn't. The fact that they can pull your registration it actually gives them quite a bit of power over the CPA firm. So they can't take their licenses. Individual licenses are given to the people. They cannot take those. They don't issue them, but the registration they do have. So they actually do have quite a bit of power over CPA firms that are auditing publicly traded companies. Okay. Oh, wait. I got one. I cut off one here. Hold on. Create the CPA exam. Nope. That's what the club does. Okay. So they only have control over issuers. They only make rules for issuers, and they only register CPA firms for issuers. They can't do anything else. Well, it is still pretty big. Okay. What's it left? Oh, this isn't bad. Oh, wait, maybe it is. I was hoping to get this done by 7, but we'll see. What types of fraud do auditors look for? Material. What type of misstatements, I should say? Material misstatements. So this is the only thing we look for. We do not look for things that are immaterial. We don't, I shouldn't say waste time, but it's not part of what we are signing off on. There's no reason to do it. So we only look for material misstatements. Okay, what is a characteristic of an error? So you make an error. So we're going to kind of delineate between these two. What's the difference between an error and a fraud? What's a characteristic of an error?
Mistake, human mistake.
Yeah, it's more of a mistake. Unintentional.
Unintentional, yes.
Yeah, so that this is something that is. There's one more thing. I can't remember what else we did. I don't know. Okay, so mistake, unintentional. So the characteristic of an error is that its mistakes unintentional. Characteristic of a fraud is what?
Intentional lie, concealment of truth.
It's intentional, yeah. And it is there to deceive somebody.
Yeah.
It's deceptive. So characteristic of fraud is that it's intentional. They meant to do it, and they're there to deceive somebody, whether it's making themselves look better or whatever it is to deceive somebody. There's a deception involved. And I think we talked about this. Which one of these is harder to detect?
Fraud.
Fraud is harder to detect.
Yeah, because this is usually has some aspect of concealment. They if they just made the journal entry, fraud expense, it'd be real easy, but they usually don't do that. So that's called concealment. Did we already talk about type 1 and type 2 fraud? I thought we did. Maybe I don't know. Type 1 fraud is financial statement fraud. Yeah, I guess we didn't do this. So these are the types of fraud. Financial statement fraud. So this is kind of cooking the books kind of thing. What we normally think of as fraud.
Hi.
So what we normally think about it as fraud, this is now type 2 fraud is this is a kind of an understatement, but it is asset misappropriation. It should not say misappropriation of assets. Commonly known as employee theft. Now, it is possible that it's just plain old theft, but for auditing, we consider it to be a type of fraud. And there actually is a legal difference between theft and fraud. Theft is when you just take something. Fraud is usually there's a deception involved. But for auditing, we consider misappropriation of assets as employee theft. And it might be legally fraud, it might be legally just theft. If I'm working at Walmart and I take a candy bar, I probably haven't gone and changed the books to cover up my theft of a candy bar. So there isn't really that deception, there really isn't that concealment, that covering up of it that would move it into a fraud. It would be theft, obviously, it's against the law, but it would, there actually is a difference. But for the AICPA, employee theft is considered fraud, regardless of concealment or anything else. Okay, question on that? By the way, which one of these two as auditors are we going to be more focused on? You know, what do we?
On fraud.
Yep. This is what we're really going to be looking at, because this is what we sign off on. We don't sign off on employees aren't taking things. We sign off on the financial statements aren't materially misstated, or reasonable assurance that they're not materially misstated. So as auditors, we focus on type 1 fraud. Okay. Compliance with laws, illegal acts, direct effect, things like tax fraud. Notice that tax fraud will also have an impact on our income statement. There's a direct effect. So taxes understated on financial statement, let's say income statement. So it's a direct effect. And we are more concerned with things that have a direct effect than we are with things that have an indirect effect, which are like what we have down here. Maybe they're breaking the law, maybe it is an environmental law. Environmental, oops. So environmental law, it may have an effect on the financial statements, it may not. I mean, sometimes they might get fined, but sometimes the EPA will just tell them to knock it off. And so these are more indirect. We don't worry as much about these as we do those that have a direct effect on the financial statements. Okay. Responsibility for detecting any illegal act. Only the detection of material. We are only looking for things that are material, not things that are not material. And if someone's doing something that is not material, you get the president of the company, and the president of the company is parking in a handicap spot illegally. While that's very offensive, it's probably not going to be material to the financial statements. So we only look for material illegal acts. So yeah, everything we do is we're looking for things that are material. If it's not material, we're not looking for them. And if they happen, we don't usually get involved with that too much. Responsibility for reporting an illegal act. I think I'm going to hold off on this one. I talk about this later. Yeah, I'll talk about this later. This comes up in the chapter 3, and we cover it more extensively in chapter. Skip. And I'll make sure I don't put anything like that in the tabs. Okay. All right, types of audit reports. The unmodified report, sometimes called an unqualified report. Oops. Called a clean report. And sometimes called a standard report. Oops. So these are what we most, this is what you're really looking for tax reports. These are the ones you usually give out, and these are the clean reports. And this is when there are you don't find any material misstatements. So no material misstatements detected. Or if they detected them, they've been corrected. So it is possible you find you find something that is materially misstated, you tell the client and they fix it. And by the way, part of auditing is that you want that to happen. People say, well, if they give it to you wrong, you just write it up then and say that it's bad. No. You want them to put out the correct numbers. So the whole idea behind the audit is people get the information and they get information that's not misleading. So we want them to get the right numbers. So if we come to them and say, look, this is materially misstated by $2 million, you need to correct this or else you're going to get a bad report. 99% of the time they'll say, oh yeah, okay, even if they don't agree with it. Well, no, that's not right. Well, either you do it or you don't get a clean report. They go, okay, fine, we'll do it. So yeah, no material misstatements, and if we find any that they have been satisfactorily corrected to what we would deem that they are no longer misstated. Okay, unmodified report. The next one is modified, and actually, I'm going to do something different here. All of the rest of these are modified reports. So the rest of these are going to be modified report. Only the clean one is the unmodified. The rest of these are called modified reports. And the first one is a qualified report. A qualified report is a material misstatement but it is not pervasive. And usually one or two accounts. Okay, so there's a lot there. Let me clean this up a little bit. Okay, qualified report. It is when they are materially misstated. However, it's not pervasive. It doesn't go through all the financial statements, usually for one or two accounts. And that the financial statements overall are presented fair. Oops. Okay. So qualified report. Material misstatement, not pervasive. Usually one or two accounts. Overall, the financial statements are presented fairly. So maybe let's say there's a problem with the inventory. We can't verify. Let's say they have inventory in a warehouse overseas that, maybe there's some kind of strife over there and we can't verify it. We can't get in there it's too hot to get in there and verify this inventory. Well, what do you do? Okay, well, it's only for the inventory, right? It's only for that inventory, and overall, financial statements can be relied upon. So this is one of those situations where maybe you can't get all the information you need, or it's unsure whether it's accurate, even the information. That there's a material misstatement. However, overall, the financial statements can be, so okay, this inventory we don't know about, but we do know the revenue, we know the cost of goods sold, we know the expenses and the taxes and all this stuff. we know a bunch of this, it's only this account or one or two accounts that we don't know about. So that is a qualified, and the qualification is that we say everything's okay except for, and that gives us its name that you'll often see it called by is an except for opinion. Because they say everything's okay except for, so these are often called except for opinions. Worst one, adverse opinion. The adverse opinion is when there's a material misstatement that is pervasive. Is pervasive. Generally say that they are not GAAP, not generally accepted accounting principles. Clean this up a little bit. The financial statements are not fairly presented. They cannot be relied upon. So this is the worst one. This is when it is, you know, the financial statements are a mess, that you cannot rely on them. Now,
Sir,
yeah,
I have a question regarding the qualified report.
yeah,
When it says usually one or two accounts, let's say you said inventory, so if inventory is, that's an asset account. If it's like misrepresented by a lot, do you go back? I'm guessing this is more of a judgment call,
yes.
or do you go to the previous, let's say a year prior financial statements and do a comparison?
You could try. Yeah, it really depends. I mean, it could be a number of different things. Oftentimes, the qualified reports we'll find out are because they can't verify something, is often what it comes down to. And it's a material account, but they can't verify it. And if you can't verify it, you can't say that these are free of material misstatements because sometimes you just don't know. It could be that they're materially misstated. It is possible that they're materially misstated, but for whatever reason, they're not going to change it. That's fairly unusual. It's unusual to get unqualified reports, and adverse reports are very unusual because you tell the client, look, you got to change these or you're going to get a qualified report or you're going to get even worse, an adverse report. And here's the thing about both those reports. You must put the dollar amounts in. So it isn't like someone's going to say, okay, I'm going to misstate my financial statements by $10 million. I don't care if they give me a adverse opinion. No one's going to know that it was misstated. Yeah, they will. It's going to be in the audit report. And not only that, people that read the audit report will now say, okay, not only is this misstated, but now it reflects on the management and they're trying to have a fraud here. So it doesn't do anyone good. Now, do adverse opinions happen? Yes, every now and then they do. You know, you get people pounding on tables. You don't need it. You need to put this,
Yeah.
So next thing you know, there's an adverse opinion, which makes no sense to anyone. But it does happen, but it's fairly rare. And they're rare because the auditors will say, look, if you don't, it's going to be an auditor, and we're going to give the dollar amounts. So these two, the dollar amounts are known for both of these. So for this one, yeah, it'll have to be the dollar amounts are known. Oops. And they'll be put right in the audit report. So there is no getting out of it. And same thing here. Dollar amounts are known, we'll put right in there. So if you misstate the revenue by whatever, $20 million, it'll be right in the adverse opinion that they're overstated by $20 million. Anyone reading it will know that you're not on the up and up, and there's no reason not to do it. Do they happen? Yeah, but very, very rarely. Okay, last type of opinion is a disclaimer of an opinion. A disclaimer of opinion is, well, first of all, oftentimes you'll see this just called a disclaimer. And honestly, it's not an opinion because there is no opinion given. Disclaimer opinion is when not enough, the auditors are unable to get enough evidence. Oops. The auditors are unable to obtain enough evidence to form an opinion. And they will get a disclaimer. And the disclaimer opinion is, they say no opinion. It doesn't say that they are misstated, you just don't know. And so in that way, they talk about types of opinions. This actually isn't an opinion, it's no opinion. And you say you cannot get enough information. And usually these are also fairly rare. Sometimes you run into it if you don't know a business, for instance, is dealing only in cash. If they deal a large amount in cash, sometimes it's difficult to know, what their expenses are, what their revenues are, and all that kind of stuff. So it's when you can't get enough evidence to, well, one way or another. And okay, let's say that they the place got robbed and someone stole all their computers. Oh, where's your accounting records? Well, someone came in and stole all our computers and all our accounting records. Okay, no problem. How about the backups? Oh, well, we put the backups in the safe. Okay, well, where are those? Well, they took the safe too. You just can't get the information. So it's disclaimers are fairly rare because you can't get enough information. Again, sometimes if you have a client that you figure out is dealing a lot in cash, you don't know exactly how much cash are coming in and going out. I had a friend who did an audit, and it was like this juice company, and the owners were bringing in some special ingredient that they were putting in this juice that would make it, I don't know, tasty or some secret ingredient, whatever it is. Now, companies have secret ingredients all the time. You can't audit secret ingredients, and they generally hide their secret ingredients through the purchasing. Let's say there's seven things that go into their muffins or whatever. They'll order 20 different ingredients and resell 13 of them. You don't know which ones they're using, which ones they're reselling. They'll resell, all of them to some extent, and they can do that kind of shuffling the cards around a little bit. That now you can audit the purchasing department, and you can without ever knowing the actual secret ingredient, you can do it. But anyway, these people brought in this, and so they said, "Well, what is it? What are you putting in?" They said, "Well, no, we're not going to tell you that." And they said, "Well, we have to. Is it 10 cents worth of stuff, or is it $10 worth of stuff, or 10,000? What are you putting? We have to know how profitable you are. We have to know what went in," and they just refused. And so they got a disclaimer because, again, they have no idea what they were putting into it, into this juice stuff. I think this was before they had laws on it. You had to tell people. But anyway, yeah, so the disclaimer is no opinion. Okay, let's go through these. And I think I'm going to Yeah, I'm gonna change something here in a second. Okay, I know I'm going late here. I usually break at 7. Okay, let's go through these and then I'll send out the, we're not gonna do the Anthony case. We'll just do the multiple choice questions and I'll send out the test. Okay. Auditors were unable to verify significant investments made by the client. Which report would be appropriate for this scenario?
The disclaimer.
Probably disclaimer. Yep. And again, these are significant investments, so you don't exactly know what they are. Okay, the auditors determined that cash, inventory, and revenues were all materially misstated. Which audit report would be appropriate? So the cash is off, the inventory is off, and the revenues are off.
Notify at first report.
Yep. Yep. Yeah, it looks like it's going through the whole thing. Cash and inventory on the balance sheet, revenues are on the income statement. You're not gonna be able to rely on any of it. The auditor determined that cash, inventory, and revenues were all immaterially misstated.
Unmodified.
Yep, very good. This is one that usually people trip up on. Yeah, if they're misstated, but it's immaterial, that's fine. Well, I mean, you don't try to do that, but I mean, Okay, auditors were unable to verify material amount of write-off of offsite inventory on a client's books. None of the other accounts were materially misstated. Which audit report would be appropriate for this scenario? And I'll give you a hint. There actually is 2 of them that they could do. So it's a material amount. That's important.
It could be disclaimer, or since material amount, but then again it says none of the other accounts were materially misstated.
Right.
So that's a key statement right there.
Yep. Yeah.
So either, I don't know, to be honest.
well, there is no, if it's materially misstated, but it's only one account.
The qualified report.
Yep. This could also be a qualified. And you might
Yeah.
wonder why would you do a qualified report? Well, a disclaimer is nothing. A disclaimer means so if you give a client that, they're not very happy. But a qualified report, while it's not ideal, it is better than giving them nothing, because they can say, yeah, well, we couldn't verify this inventory. However, the sales are okay, everything else is okay. It's this one account. The land's okay, the cash is okay, all this other stuff, the liabilities are okay. So it gives you something. They at least could go to the bank or their investors and say, well, look, yeah, they can't verify this. However, the rest of the stuff is okay. So a qualified report is they'll say the second best report to get, because it'll say, okay, there's a problem here, but everything else can be relied upon. So if you can, this is I don't know why I just did this, but this will be, I don't know, happy clap marks, or I don't know, whatever they are. So if you can give them a modified report, a lot of times you'll do it, because it'll, a bank looking for information. I guess there are only 3. Okay, why are qualified and adverse opinions rare? So these are the bad ones.
A.
Actually, it's going to be B. They're rare because they're not going to get away with it. And so oftentimes when you tell them, look, you're going to get a qualified or adverse opinion if you don't change this, they see the light and they change it. So it's actually fairly rare. Now, if the clients, if they hid it from somebody, they wouldn't have any of these on there too. But generally speaking, they're rare because oftentimes the client will succumb to rational and thinking, and yeah, and they'll change the report. So they are fairly rare. Do they happen? Yeah. Almost never do they have the adverse happen like for publicly traded companies. I've never seen an adverse opinion for a publicly traded company. The SEC would just stop trading on their stock immediately. But yeah, they are rare. They're rare to have. Okay. All right, so anyway, we're gonna take a break, but what I'm gonna do is I'm gonna send out the multiple choice questions, and we'll do this as a class, and I will put up a poll. It's gonna have 10 questions on it, and you'll put your answers into the poll. You have to put in all 10 of them before you can submit them. So yeah, I'll start the poll here. Okay, so there should be a poll that shows up on your screen, 1 through 10. And I will send out the make sure I deleted the right ones. And you should get in your email, the multiple choice questions should be showing up shortly. And we come back. So when we come back from the from break, we'll kind of go through it, and as you can go ahead and work on them anytime and put them in. And when we get the whole class, hopefully the whole class will participate in this, that we will be able to see what you guys did, and you get extra credit points for this. And the extra credit points are, I'll put it in here. We'll put it on here. So, oops, you guys can't see what I'm doing. Okay. So multiple choice questions. As a class, if you get 5 correct, you'll get +2. Ooh, I just spelled correct.
Professor, did you already send them out?
I just sent them out. Let me see if they should get. I don't know if they've gone through yet.
Oh, I think I just got them.
Yeah, I got them.
So we should do it now or after the break, or
Either one. But yeah. So here's what we'll. So if you get 5 correct, if you get 7 correct, +2. No, not +2, +3. If you get 9 correct, oops, +4. And this is as a class. And if you get 10 correct, you get +5. Now, the individual, you'll not get the individual names or anything after it. So don't think like you're gonna have if you get one wrong, people are gonna get mad at you or something like that. And by the way, it's as a class. So if 51% pick one answer, that's the answer we're gonna get. So don't worry too much about it. If you will not, your name will not be associated whenever you turn in. These are anonymous. And so in the poll, they're anonymous. Or anonymous, as I like to say. Oh wait, it's still wrong. Oh, why? I kind of like anonymous. Sounds better. So yeah, as you figure out whatever you get for number 1, put that in, number 2, blah blah blah. You get the idea. And I will. And this will be the only thing. This will be the last thing we do today. Put the best answer in. That's the CP. the CPA exam rules, they don't look for the correct answer, they say put the best answer in. And you're gonna take a break, then you come back in like 10 minutes or something like that if you want. Yeah, so the, by the way, you can always submit the stuff, I'll take the stuff late, anytime, and I'm gonna move the time back for the, classical sampling. I doubt we'll finish it next week. But anyway, yeah, so the only thing we're gonna turn in today is, nope. The chapter 1 and 2 handout we finished. So this will be, the only thing that we'll turn in for today. The Anthony handout, we haven't done it yet, so we'll do that next week. And I'll move that back too. I generally give a week from Friday. So what are we on? Third? Yeah, so what is it, like 10 days? So the handout now. So the only thing we're going to turn in for today is this handout. And also the exam, which I'll be sending out after class. So the exam will be sent out after class, and that'll be in your email account. It will not be in Blackboard because different people will get different. Different people will get different form A, B, C. You get the idea. But yeah, so it'll be in there. Ooh, almost everybody is in so far. Oh
Yeah, Professor, can we go back to the Access book issue? Were you able to get any information regarding the Lakers bundle?
Yeah, no. So here's the thing: when they pulled it up in the Laker bundle, it only showed the one book in the Laker bundle. When we went into the non-Laker, but when they call the opt-out, we went into the opt-out. It showed both the books, and those are both at full price. You actually only need one of those. If you opted out of the Laker bundle, but if you're in the Laker bundle, they should give it to you. Did you contact the bookstore?
I'm gonna call the bookstore tomorrow because they told me to wait. It says when I go on my other classes, the books that I have from Lakers bundle were automatically, like I had a code and I could access them. But this one for this class, for some reason, it does not show me any links or anything. It shows the book under my course schedule, but I cannot access it. And I'm gonna call them tomorrow again.
Okay. Okay, yeah, it says they're not sending out physical books. Yeah, that's unfortunate. Well, I guess it's not. I mean, I understand it, probably.
But in order for us to get the physical book, do we need to report this to them, or how does it work? Do they send it automatically to everyone?
Actually, it looks like they're probably not going to send out the physical book, which is not what I chose. They told us to go the full board, take everything, but if they're not sending out the physical book, they must have changed the program or something.
Yeah, I'm gonna call them tomorrow because this is just getting ridiculous.
Yeah, it is. And yeah, so under tools, when you go into the BNC materials, let's see if mine is working. Mine's not working. I'll figure it out. I'll figure out mine, but yeah, they probably did something to change the program. I'm assuming.
Yeah, I'll call them tomorrow because what I'm understanding is for the exam we need to have the book in order to complete the exam. Am I correct?
No,
We don't?
no. It's the exam is a written exam. You can either do it right on paper. You can either write on paper and take a picture of it. You can do it right.
Yeah, I understand that, but in order for me to get answers for the exam, that the answers are in the book, right?
Most of them will come out of the handouts. And actually I'll put the answers up here in a second, but it looks like everybody has turned it in.
Oh, okay.
So actually I'll go ahead and share the results. So a couple things about the exam. Almost everything in the exam should come out of the handouts. Most of it does. And I kind of go through the chapters and pick and choose those things that are important or more important to put in there. There is another thing though that I should probably talk about, and that is the artificial intelligence stuff. You generally don't need to do that in this class, and the reason normally it wouldn't bother me, but the problem is that you usually get wrong answers out of it. And so I'll ask a question, what's the decision on this, and then I'll get a list of 10 procedures. Well, there's not 10 procedures. There's what's the answer to this and why. And so be very careful about using AI. And it doesn't bother me to use it, but usually you get really bad answers, and you get 6 paragraphs of bad answers. So be very careful, especially in this class. Most of the stuff that we have that will come out of the almost all that comes out of the handout to some extent. Okay, let me go ahead and share the screen. We'll go through the answers and we'll see how we did. Number 1, correct, compliance audit. Number 2, any disputes? Yep. Three. I didn't talk about this one. You guys got the answer right, though. By the way, the CPA exam, just so you know, these questions, we're gonna take, okay, yeah, I'll take a look and see. On the CPA exam, passing the CPA exam is roughly, it's not exactly, but roughly like 75%. So if you get 75% of them right, that's your goal. So if you do get any of these wrong, and when you're studying for the CPA exam, one of the things you have to get used to is that you don't always know the answers. Who's responsible? Management? Yep. Which of the following types of services generally provided by only CPA firms? Financial audits. Tax audits are going to be done by the IRS usually, or the for state revenues. The right to practice CPA is given by state boards of accountancy. Seven. D is correct. It's a tough one. And this is one of those ones, the true directions for given for CPA exam are you pick the best answer. So it doesn't mean that there's only one right answer up here. It just means that you pick the best one, what they would consider the best one. Operational audit. Yep. Yep. Sarbanes-Oxley. The act that nobody wanted until everybody wanted it. Auditors performing examination. Yeah, we never say, we never give absolute assurance. Well, you guys got 5 extra credit points. Very good. Okay. Let me download that real quick. Oh. Oh. Yep. This is week 2. Okay. Looking at my screen. There we go. Okay, so yeah, so the only thing we're going to turn in from this week, as far as the handout is concerned, is handout chapter 1 and 2. Nothing else is due. And then I'm also going to send out the exam. The exam will probably not. I'm probably going to send that out till probably like 10 o'clock tonight. But anyway, you'll have 10 days to do it, and you know, so you'll have plenty of time to look it over and all that kind of stuff. And let me see if I can get the link up for the ebook. And there's someone said, you know, you go through Connect, and I'll try that again. Usually it'll, when I click on that, what I just went through, it'll show my instructor portal, but maybe it's not doing that anymore. So we'll take a look at that. But anyway, I should have the ebook link should be up there shortly. Okay, any questions? All right. Let's go a little longer. Well, we'll next week we'll do the Anthony case and all that. And but anyway, so look for your email. Well, like around 10 o'clock tonight, you should have your email for the chapter 1 and 2 exam, and you have 10 days to turn that in. Everything that gets turned in on all assignments and exams. The handouts will have that we do in class will be listed here. The exams will be emailed, so you will not be able to get your exam from Blackboard, but it will be in your email account. Okay. You guys have enough fun? Look at that, 2 minutes early. What are you guys gonna do? All right, I will see you guys in a week. Okay, good night.
Good night.
Hi, Professor.
Good night,
Thank you.
Professor.
Thank you.